At present, most of these funds in the Caribbean and also in developed countries are at risk of running out of money. Hi, I'm Tanja, and in this video I'm going to speak about national insurance schemes and your retirement. National insurance schemes were created in the Caribbean back in the 60s and 70s, with the first one being established in Jamaica in 1966. The purpose of these schemes were to be able to help persons retire better and were to be able to allow the population to have some level of financial security as they age. The schemes are managed by statutory boards and they are financed by you, the worker, and your employer. These funds are then invested mostly in government bonds and other low-risk investments. At present, most of these funds in the Caribbean and also in developed countries are at risk of running out of money. I know there have been a lot of conversation going on in terms of raising the age limit at which persons can retire, and there are some countries who have already gone ahead and done the work in terms of passing the laws to do that. I think currently most of the islands are probably about 67 age now in terms of when you can retire, and there's also some conversation of moving that retirement age to 70. If something isn't done within the next 10 years in terms of massive pension reform on some of these islands, the possibility of there not being a pension for many persons when they retire is actually very high. And that is something that I think that everyone out there, every worker out there, unless you're at a position where you have been able to or you plan to financially secure yourself in terms of financial freedom, that you do not need that state-owned pension, then this is something that you really need to be paying attention to. The reasons for the schemes running out of cash or being able to provide those pensions for persons range from low economic activity within the region, from the high youth unemployment rates, and the youth unemployment rates in the Caribbean go as high as 24 to 26% in some countries. And if there are not those persons paying money into the scheme, then those individuals that are hoping to get money out of the scheme will not be able to do that. There's also a level of brain drain that's going on. So some of the brightest and most productive young people, or not even all young persons out of the region, are migrating to territories where they then will be able to benefit from those persons working. And the Caribbean will be left with not enough people paying into the scheme. There is also elements of mismanagement, which obviously will not be addressed or will not be admitted to, where the schemes have been used to fund private projects and other projects or even government projects where there is no economic activity to flow back into the scheme. With all that said, then my question is, what are you planning to do about your retirement? In order for us to start to talk about retirement in terms of financing for retirement, then you need to know exactly how much money you need to retire. And there are actually calculations out there that you can use to determine how much money, or to estimate how much money you think that you will need for your retirement. One of the easiest calculations is to look at how much money you actually spend in a particular year. For example, you will look at your annual costs of living per year, and then you multiply that by the estimated number of years you expect to be retired. So let's do this scenario. You're going to retire at 60 years. Life expectancy is, let's say, 85. And yes, I know people do live much longer than that. So you will say between the time in which I retired and the time in which I have estimated for my life expectancy, there's 25 years. So you take that 25 years and you multiply it by how much money you are expected to spend within that and within any year for your living costs. There are certain estimates that you will have to do in between there, because one of the things that you will have to look at would be, will I still be paying for a mortgage when I retire at 60? Will I be paying rent? What will be my housing situation? So based on those particular criterias, then you're able to come up with a better number. Because you're paying a mortgage now doesn't mean that that is what you've estimated for yourself when you're retired. So it means that you don't need as much money in your retirement as you currently do now. So looking through your expenses and being able to see which of these expenses I'm still going to have in my retirement is how you will start that exercise. Of course, there's going to be an element of inflation in there. So when you do that calculation, you will have to then be able to estimate inflation rates in terms of, okay, insurance will continue to go up. Maybe the cost of food will continue to go up, and be able to put in an estimate to help that inflation. But without complicating it and talking about inflation, etc., the basic calculation is for you to estimate how many years you expect to be on retirement and what your cost would look like per year. And that will give you an estimate of how much money you actually need to retire, as in the lump sum amount. It doesn't mean that you have to have that amount when you retire, or it doesn't mean you have to have that amount sitting in the bank, but that is the amount of money that you will expect to spend in your retirement. So therefore, you need to know exactly where it's going to come from. Once you've established how much you need, then you have to start to look at where is it going to come from. Is it going to come from a private pension I have? Is it going to come from a business that I own that I plan to sell? Or maybe I don't plan to sell my business, but I plan to continue to be a sleeping partner, so I will still earn profits from it. Is it going to come from my state pension? Is it going to come from passive income? Am I hoping or relying that family members or children are going to help supplement my income in my retirement? You have to be very realistic about where your retirement funds are going to come from. And if you are at the point where you are not yet there to retirement, this is something that you can really start to look at in terms of how you're setting up your investments, or how you want to set up yourself financially for the future. Because you're looking at options of like, okay, when I retire, I may not be able to rely on my state pension. I may have a private pension, but it offers me only X amount, or I'm not sure about that. And we all know that there are cases in the Caribbean where pension funds have disappeared because the companies have gone under. And I've spoken about this before, and I've also written about it in my book Living Loud on a Budget, because I was one of those persons who lost a pension fund in one of those scenarios. So these are things that you're going to have to really think about, look at, and make some decisions with regards to where is the funds going to come from for me to be able to retire comfortably. If you're looking at passive income, do you have another home besides the one that you're living in that you can rent out, or that you currently rent out? Do you have residuals coming from royalties? Maybe you're a musician and you're going to still get something coming in from that. You know, there are options out there, but you have to be able to know, or you should decide early exactly where you expect your funds to come from for your retirement. And as stated before, it doesn't mean that you necessarily have to have $1 million before you retire if that's what it comes. But it means that you either have to be valued at that amount, or what you're currently valued at plus what you expect to be coming in will cover that amount, the calculation that we would have done previously. Now, as part of your net worth, you may have a house. So let's say you're currently worth, or you expect to be worth $700,000 by the time you hit retirement. If you have 300,000 or 400,000 of that wrapped up in your home, then you will understand that if you're counting that towards your retirement money, it means that you've made a decision either that you're going to do a reverse mortgage. And I'm not 100% certain whether reverse mortgages are something that are currently being done in the Caribbean. But you also have to decide if, as part of your strategy, you're going to sell your home to be able then to use that cash from your home as part of your retirement strategy. And if that is the case, exactly where will you continue to dwell? So these are decisions that you don't necessarily have to have all the answers for now, especially maybe at your age. But these are decisions that as you go through your life, you're going to want to keep in the back of your mind, because as you work towards your financial goals, you're going to have to decide exactly what you're working towards. If you've not yet started to work on your retirement plan, or you've done the calculation and you're nowhere near the number that you think that you will need to retire, it's never too late. There are options that you can choose depending on your age will determine exactly what type of options that you want to go with. How you will do that is that you can look at the different streams of income that you currently have. If the only stream of income that you currently have right now is your 9 to 5, then you know, okay, I need to create passive income for myself. What can I do to create passive income for myself? Can I start a business now that I can get either a family member or someone else to carry on in the future when I'm retired, and be able to start and be able to secure some level of income from that? Do I now decide to go with a private pension plan because I know my state plan isn't going to cover it? And just in case you didn't know, your retirement funds, or what you get for your pension from your state plan, is not going to match exactly the salary in which you are getting currently. There is a calculation which works out, I think in most of the countries, it's about 60% of your insurable income. And from the little research I've done quite recently, I also see that some of the governments have been making changes to that calculation. So that is something else that you will want to pay attention to. And what you can actually do, if you're very close to retirement, you can actually, or maybe a few years out, you can actually pop into your national insurance company, the government agency, and you can ask them to do a mock-up for you, which will show you exactly how much you will get when you retire. And this is information that you can use to actually make the decisions that you will need to make. Retirement and pension is not something that we all want to speak about, especially if we are of a certain age. You know, you think that that's something down the road, but we live in a world now where we don't just get to waffle through and just wait for down the road, because our financial life depends on us making decisions. And it's not only the financial aspect of it, but your financial life is actually tied to the quality of life that you are going to have. In a previous video, I spoke about 5 things that money can buy. And in that video, I spoke about things like medical insurance, mental health, peace of mind. Those things that you don't always be able to attach a financial number to, but those things that the only way that you're going to be able to enjoy a quality life is by having financial resources that you can put in that particular area. And as we age, medical is one of those things that will become a major factor in whether or not you're able to live a quality life. So retirement is something that you should be thinking about, not just when you get there, but way before you get there.